We've all had this nightmare before. You finally achieve your dream of owning a home. After years of saving, you're finally holding the keys to your home in your hands. You have that feeling of satisfaction that you've finally made it. No more dealing with real estate inspections, no more bond cleans, a place to call your own. Only to overhear the news and find out the property market in Australia is tanking. It was down 20% last week, another 30% drop expected next month. Your years of saving are up in smoke and your home is now worth a fraction of what you paid. You're the laughingstock of your friends and you're financially ruined for life. We've all had this nightmare and it is completely terrifying. So if you're fearing a market crash could turn your dream of owning a home into a financial nightmare, you're not the only one. So let's break down what would really happen if you bought a home and the property market took a complete nosedive. In this video, we're going to look closely at the data across previous market downturns, understanding what happens to your house price if the market crashes, and what this means if you're thinking of buying a home in 2024 and beyond. Let's start with understanding how homes are valued. How do you actually know what your house is worth? Unfortunately, it's nothing like the share market. A lot of people, when talking about the property market, talk about market values, appraisals, renovations, but when it all comes down to it, the true value of home is what someone else is willing to pay for it. Sounds too simple, right? Well, there's a bit more to it. Imagine you've got your home. It's your castle. Your kids took their first steps in it. You stayed up until midnight the week after buying it, painting the walls. The paint has your literal blood, sweat, and tears in it. To you, this castle is priceless. But to others, it could be a different story. So how do you know what your house is really worth? Well, the moment of truth only comes out when you hand over the keys to the new owner. How to get close to understand what your house is actually worth? You need to look at what other people have paid for houses like yours. I'm talking houses in the same neighborhood, the same charm, the same quirks. This is where comparable sales comes into play. You need to look at the same amount of bedrooms, the same amount of bathrooms, the same amount of land, and properties that have been sold in the last 6 months. Renovations and additions that you've made to the home since you bought it can help, and equally leaving your home get into disrepair can make it lose value. Navigating the downward spiral of house prices. So imagine this, you've taken the leap and you've bought your dream home for $550,000. You'd be feeling on top of the world, but then the unexpected happens. The market begins to drop. A month after you bought, your neighbor lists a similar house, almost the same, for $550,000. What you paid, but eventually sells it for $520,000. Suddenly you're left wondering, is my new house only worth $520,000? It's like watching the value of your brand new car drop the moment you drive it off the lot. But let's not stop there. What if neighbor number two's situation was dire? They just lost their job and they list their house at $520,000, but they quickly dropped their asking price to $480,000 for a quick sale. It's a tough pill to swallow, realizing that your home might only be valued at $480,000, a far cry of what you paid a few months earlier. And then, as if on cue, several more houses in your neighborhood sell for $480,000. It's not just a one-off, it's a trend signaling a downturn in house prices. The plot thickens as the market softens further. Sellers desperate to attract more buyers in a falling market start slashing prices even more. The next house lists for $480,000 and then sells for $460,000. Then another sells for $440,000. Another sells for $420,000. Each sale is a breadcrumb leading potential buyers to see a clear pattern. Prices are tumbling down. This scenario paints a little bit of a picture on how prices can spiral downwards during a market crash. Your once $550,000 house could now be pegged at $420,000. Not because the bricks and mortar have changed, but because the perceived value has shifted dramatically in the eyes of potential buyers. And it's critical to understand that unlike the stock market where you can get a spot price for your shares at any given moment, the value of your home is woven into the local market trends and comparable sales. Each sale in your area becomes a bit of a thread in this tapestry into the perception of what your house is actually worth. So what does it actually mean as you as a potential home buyer? It's a stark reminder that housing market is a living, breathing entity impacted by a myriad of factors. This goes from economic conditions to local supply and dynamic demands. And while we can't individually control the market, understanding these patterns helps us navigate the ups and downs with our eyes wide open and prepared for whatever comes our way. What actually causes a housing market crash? So let's dive into the factors that can actually cause a market downturn. A market correction is considered a reduction in prices of 10 to 20%. A market crash is considered a reduction of 20% or more. So first off, a housing market crash isn't just one bad auction. It's when we see house values plummet across the board by over 20%, and it doesn't happen overnight. It can take months and sometimes years for this to occur. In fact, in Australia, the last time we had anything close to this was in 1990, the recession we had to have. The crazy thing is, the downturn in housing was pretty mild. From peak to trough, prices declined nationally by just 8% in real terms. Compare this to the stock market where we had Black Monday in 2020 and the ASX lost 30% from peak in March March 2020 and had a record losing 9.7% loss in a single day. The difference between house and stocks is that unlike stocks that can be sold in a click of a button, it can take months to prepare a home for sale. Think about it, you've got to arrange photos, get the listing online, arrange physical inspections for people to go through the properties, they arrange their finance, move in. It can literally take 2 or 3 months from listing to selling a property. And because of the slower market direction and lower volume, property shocks can take a much longer time to work through the system. So what does cause a housing crash or even a downturn? There are usually a couple of common factors here. High unemployment rates mean there's fewer buyers out in the market, people don't have jobs or stability, so there's less demand, and that's it, prices will come off. The second one is interest rates. As interest rates increase, houses become less affordable, people have less borrowing capacity, and there's gonna be less demand the higher they are. The third one is economic recessions. This is where the economy actually goes backwards and shrinks, people have tighter wallets, and that leads to softer prices. Although it is worth mentioning that in previous recessions, Australian house prices weren't that badly affected. And the fourth thing that can affect house prices is the tightening of credit. If banks start getting stricter on lending, it can make it harder to get a mortgage, there's gonna be fewer loans, fewer buyers, and prices are gonna go down. But this is where there's a bit of a twist. If you're not looking to sell or refinance, these market waves are just a bit of background noise. Whilst your home value might fluctuate on paper, its real value stays solid unless you decide to jump into the market. But after all this, I'm sure you're wondering, is Australia's housing market headed for a crash? Whilst no one's got a crystal ball, we can see from history Australia's property dynamics tend to protect us from major crashes. Compared to the American or Canadian markets, unique drivers like population growth and supply issues mean that downturns in the market historically have been minor and pretty short-lived. So while the thought of a housing crash might completely freak you out, understanding what leads to one can give you a bit of knowledge to understand that you might be able to weather the market conditions if it were to happen. Keep in mind, your home is more than just an investment. It's a place to live, it gets you stability, in the grand scheme of things, that's really what matters. Alright, so the big question, what happens if you buy and the market crashes? To paint a clear picture, let's dive into some hypothetical scenarios of what could happen if the market takes a tumble. Meet our friends, Stretch to the Limit Liam, Savvy Sam, and Timid Taylor. Each represents a different approach to buying a home, and each will face the market's ups and downs in a unique way. Are they going to weather the storm or are they going to struggle? Let's find out. First, we have Stretch to the Limit Liam, the emotional buyer. Liam went all in when buying a house, pushing his financial limits to the max. His mortgage payments take up more than half of his income. When the market takes a dive, Liam's financial flexibility dives with it. Refinancing isn't an option because the banks say he doesn't have affordability, and selling would mean he'd take a loss. Liam's tale is a cautionary one. It's pretty generalized, obviously, but it shows that overextending yourself can turn your housing dream into a financial nightmare if the market turns sour. Scenario 2, Savvy Sam, the prudent buyer. Sam's the kind of person that reads the fine print, plans for the unexpected, and has an emergency fund tucked away. By choosing a home well within her means, Sam's mortgage payments are manageable and not monstrous. So when the market downturn hits, Sam stands firm. The housing values might dip temporarily, but she's in it for the long run and able to weather the storm without upending her life. The main takeaway here is having some emergency funds, having 3 to 6 months in repayments as buffer if something happens to your job, insurance is in place to make sure you can weather a storm if it happens. Number 3, Timid Taylor, the observer. Taylor's watching for the sidelines, hesitant to dive into the market and the home buying pool amidst all the market uncertainty. By holding off buying, Taylor avoids the potential of the market crash. No worries about falling homes or values or mortgage mayhem. But Taylor misses out on potential joys and benefits of home ownership, like building equity or catching the market back on its way up. Now, Taylor's path might be safest, but it's also worth remembering where play it safe, you miss out on opportunities to grow. So whether you're Stretch to the Limit Liam, Savvy Sam, or Tim and Taylor, the key to navigating a housing market downturn is understanding your financial landscape and making choices that align with your long-term goals. Remember, the goal of home ownership isn't just about buying a house. It's about doing it the right way so you can enjoy it come rain, hail, or shine. By working with a mortgage broker, you can plan wisely, understand your limits, and you can ensure a dip in the market is just a bump in the road, not the end of your journey. Realistically, the best time to buy a home is when you're ready, both financially and emotionally. So wrapping it all up, a crashing market sounds like a horror movie scenario, but really you're only a villain if you're forced to sell and lock in those losses. Remember, the market ups and downs are just part of the ride, but your home's value isn't just a number, it's your castle and your sanctuary. Where possible, buy within your means and keep a bit of a safety net. For the future, you never know what's going to be around the corner. So if you made it to this part of the video, leave an emoji below. We'd love to see your little castle, see you're watching. At Hunter Galloway, we're the home for home buyers across Australia. If you're wondering if you're Savvy Sam, Timid Taylor, or where you stand from a financial perspective, hit us up at huntergalloway.com.au. We're the home for home buyers across Australia. We can work out your financial situation and what's going to make sense in terms of repayments for today and into the future. That's it for today, guys. Hope you enjoyed the video, and until next time, see ya.